Wir haben hier am Institutional Money Kongress Professor Christopher Pissarides, den Gewinner des Wirtschaftsnobelpreises 2010, der uns einige Fragen zu seinem Vortrag hier am Kongress beantworten wird. Professor Pissarides, in your presentation here at the Institutional Money Congress, you made a kind of bridging between labor market and financial markets. What are the main characteristics which you found in that relation?
The main characteristic is that there is a lot of imperfect information and uncertainties about the quality of a match, the quality of a meeting, for business purposes, of course, between one person on one side of the market and the other in the other. In the labor market, it will be the meeting between employer and worker. They are uncertain about what kind of job they can form together. The employer is uncertain about the skills of the worker is uncertain about the requirements of the employer. So it takes time to form these matches, and sometimes they're unsuccessful and they break up after they're formed. And we see the same in financial markets, in that the lender is uncertain about the quality of the project that the borrower is bringing along. The borrower is uncertain about the terms that the lender will require of the loan. So it takes time for each side to study and think. You know, the borrower will think, do I want to get into a borrowing lending relationship with this person? The borrower might think, is he the best banker for me? Is he the best provider of financial services for me? And so just in the labor market, we see this period of searching for the best partner you can have. And we might also see unsuccessful matches that we might think in the beginning, yes, we can get on well with this person, but after a while we realize that we cannot, and therefore they break up. And that's the case of a bad loan. We break up the relationship, the money is lost in the financial market. In the labor market, the job is lost.
If we come back to the similarities between financial markets and housing, can you explain somewhat more precisely what your findings are regarding this topic?
Now, housing has the same feature, because when buyer and seller meet is to exchange a house, and the house has characteristics that are very peculiar. Some characteristics of a house appeal to some people and they don't appeal to others. So we need to inspect the house before buying it, and again we need to see more houses in the market before we can decide which house is best for us. And again, we might move into a house and think, no, we made a mistake, and then we get construction workers in and they work on it and we spend more money on it. And that's part of the search and matching process. That's the similarity in the housing market. The main finding in the housing market is that we can explain booms and busts. In many markets, prices vary, but not very much. You know, they don't jump up and then come down again and then up. In the housing market, we see this a lot, and we might ask why. And the reason is that people like being in the market when there is a lot of activity going on, where there are a lot of houses on offer. You know, if you're buying a house, you want to see a lot of them before you buy one and make sure, because you don't like changing house all the time. And therefore, when there are a lot of houses in the market, sellers can put up their prices a lot, because that will still attract the buyers, because they think there are so many houses now on offer, I'm sure I can find one that I really like. And the opposite happens when there aren't many houses. The sellers really have to reduce their prices to induce the buyers to come onto the market. And therefore we explain this excess volatility in house prices with this theory.
You stressed that in financial markets as well as in labor markets, it takes time to find good projects to support. Can you give us an example?
Yes, I mean, imagine you're a young entrepreneur. You suddenly have this brilliant idea on about anything. It can be any project that you have that you think is going to work. You know, it could have something to do with a new internet service. You know, that's how Google started, for example, and other very successful internet projects. But you need someone to lend you money in the beginning, because you cannot sell yet. You know, you need to pay 1 or 2 employees. You need to pay yourself. You need to find premises. You need to buy computers. You need to sit down and work it out. And you go to your bank manager and say, I have this brilliant idea. It's going to dominate the search engines of the world. It's going to change the way we think. It's going to introduce a new word in the Oxford English Dictionary. And I want you to give me some money to get it started. Well, what do you think the banker will say? Yes, here is the millions, you can have them. I'm sure he wish he had given them to some of them. But there is a lot of uncertainty, so they have to wait, they have to talk, they have to impose a lot of conditions, they have to start, and a lot of these projects are unsuccessful. So you don't blame them for investigating that, and that's why in the more successful countries in this area, like the United States, lending is actually taking place outside the formal banking sector, because there are people who are prepared to take more risks, you know, what's known as the angels of new companies and the venture capital providers. We don't have that in Europe very much yet, but we need to have some more speculative lending after some research, but not to the extent that a formal financial institution will do.
Some economists claim that the natural rate of unemployment has risen permanently. That could mean that we will have a recovery without creating jobs, and eventually inflation will take off at higher levels of unemployment than in 2007. What can be the consequences?
Well, the consequences of that will be a world that will not be as good as in the mid-2000s, you know, say 2005, 2007. We could have it, but I don't believe we are going to get it. They justify that on the basis of the fact that there isn't very much innovation activity taking place now in our economies, in the Western economies. That the emergence of China and India, they're huge markets. They are going to wipe out our manufacturing base. There is some truth in that, but manufacturing is employing a small fraction of our population. It's employing under 20% of our population. Not just manufacturing, only production industries. And I think the future is in the service sector, and in a small manufacturing niche that will produce the top quality products. You know, I mean, look at the Italian clothing industry, for example, how it's changed from producing mass numbers of cheap T-shirts, and it's now employing a very small number of very expensive T-shirts. They're still selling them, you know. The same goes with the car industry. You know, the German car industry used to produce very big numbers of very small cars that you used, known as the people's car. Now it's producing luxury cars for the CEOs of the world. You know, we still have a future in Europe here. Admittedly, those top brands will not employ many people, but the big number of people we employed in the service sectors. And if we look at the trends over the last 20 years, which I expect will continue, the creation has been in health, education, in personal and community services. We expect higher standards as we're becoming wealthier as nations.
What does that all mean for the different sectors of an economy, and how should policy behave?
Yes, I've already anticipated that to some extent. What it will mean is that there will be even a bigger service sector than we have now. You know, you might say, well, now service sector is employing 80%. Is it going to be bigger? I expect it will be bigger. Yes, it might go up to 85%. You know, whatever. What it means for government policy is that policy should not think that only manufacturing is creating wealth. Services are also creating wealth. You know, if you are ill at home and a nurse comes to look after you, she's creating wealth. You know, you are paying her for a service that she's providing, and the money you are giving her is part of GDP, is of our gross national product, is part of our wealth. And government should not think that it must support industry, because if we lose our industry to Asia, then we don't have a future. That's not true at all. It should stand back from the economy, regulate, of course, where necessary, especially in the financial sector, but also in other sectors. You know, the labor standards have to be respected. But it should allow this process to take place, because it's for the benefit both of the new industrial nations of Asia and for us. You know, this increased trade that's taking place.
Thank you very much, Professor Pissarides.